I want you to tell us what you think, Oscar is worth today, and what are your long-term targets for the stock price?
Of course, yeah. So,
What's going on, everyone? Welcome into another video. Today I've got a special guest with me. This is Anthony Castro. Anthony, thanks for joining us today.
awesome. It's great to be here. And if you know me from Twitter, it goes by AC. Everyone calls me AC on there, so it's a great time. And if you do know me, it's probably because of Oscar. And that's what we are here to talk about today.
Absolutely. And I'm super excited to dive in to Oscar and hear your thoughts. But before we do that, why don't you just tell us a little bit more about yourself and how you found Oscar?
Of course, yeah. And the first thing I do want to say, just so I don't get any trouble, I'm not affiliated with Oscar in any way, shape, or form. I'm just a very, very interested investor. But anyways, I ended up getting into Oscar actually through just seeing a tweet online a while back. And then I started looking into it and I started to get the understanding of the market was completely mispricing the stock. It assumed that enhanced subsidies would basically clear their plate of members and they were going to be going bankrupt. And that was far from the reality of the situation. And after going through their numbers, their financials, revenue growth, member growth, everything across the board, I asked myself the question of why would 2026 be any different? And that was a big talking point with the enhanced subsidies going away. And ultimately, they did very, very well. And since I got into Oscar, the stock has done absolute tremendous. I've ridden the stock from 14 to 22, all the way down to 1085, where I tripled down and went basically full margin. And now we're almost 27. So it's been a good run.
Yeah, that's awesome. So we'll dive into the enhanced subsidy a little bit later in the interview. For now, I want you to, for those who don't really know about Oscar, why don't you just give us a quick rundown of Oscar Health and who they are and what they do?
Of course, yes. So Oscar Health is an insurtech that gained a lot of popularity in 2021, 2022, just because of the rise of artificial intelligence and just technology in general. And what they were doing is bringing technology and adding a SaaS platform essentially onto a typical ACA insurance company. And because of that, they gained a lot of traction. Their IPO was incredibly hot, and then trading around $37, almost $40 a share, and then eventually tumbled all the way down to around, I want to say, $3 a share. And that's when they brought in an industry veteran, Mark Bertolini, who ended up taking the business around quite a bit. Ex-Bridgewater, Aetna, he's worked at a lot of major companies. He did I believe, a $70 billion merger with CBS Aetna. Very, very experienced guy. And when it comes to Oscar, this was kind of something new for him because Oscar is a pure ACA, Affordable Care Act, or some may know it as Obamacare insurer. And with Oscar having such a concentrated group of membership, that is where people get a little worried, especially with a lot of the policy risk, especially after what happened in end of 2025. But when they are so concentrated in ACA, it also allows them to be specialists, I guess you could say, in the marketplace. And they've gotten a really great grasp on how things have really developed over a harsh 2025 for the entire market. But also, even early on in their days, they weren't just a pure ACA. They were actually in Medicare Advantage as well, but a much smaller portion of their business. So they are a very interesting company, and they are in a boring industry, but they are really revolutionizing the future of healthcare.
Yeah, absolutely. So would you classify Oscar as more of an insurance company or a tech company?
I would say right now, the company is currently pivoting more so towards an ACA insurer, but with a beautiful tech side. I'll say that because their ACA platform is expanding very, very rapidly. I would like to call it a hyper growth insurance stock. I can't believe those words are coming out of my mouth when we're talking about health insurance specifically.
Yeah.
But they grew very tremendous numbers, 2 million members at the end of 2025 to 3.5 million at the end of the 2026 open enrollment period. And what we're going to be seeing going forward, in my opinion, is that in 2026, towards the end of this year, we're going to start seeing the effects of Lucy going into the first open enrollment period, that it can actually take effect because the open enrollment periods start towards the end of the prior year. So somewhere around November 15th, we're probably going to start getting some updates on Lucy and developments around that. So that's going to be a very awesome side to explore going to the end of the year.
Fantastic. And I'm actually super glad you brought up Lucy. And I do want to dive into Lucy right now just a little bit. I think Lucy it's a very big opportunity for a growth vector for Oscar down the road from the research that I've done into it. So why don't you give us a quick overview of what Lucy is and how you think it could help Oscar's business grow in the future?
Awesome. Yeah. So Lucy is essentially the platform that employees, employers, insurers, and brokers can all meet on one platform. And essentially, before we actually get into Lucy, I want to mention ICHRA first, because Lucy is purely for ICHRA. And ICHRA is an individual coverage health reimbursement arrangement. It's a very tricky acronym, but basically what it is it's defined contribution, meaning an employer will say, okay, here's $200 a month to buy your health insurance. You can load that into Lucy, for example, and say, okay, Lucy, I need health insurance. What is what I need? Like, what insurance best fits my current situation? Mm-hmm. And because now you have access to brokers, all of these insurance plans, you have everything you could possibly need, whether it be dental, vision, health insurance, all in one platform. It creates this marketplace experience, which is really the future and what people are talking about as the future of healthcare when it does come to ICHRA, because ICHRA is essentially giving choice to the consumer mm-hmm. and allowing them to choose what actually is the best fit for them, rather than a typical small and large group insurance, which is also another great topic, actually, small and large group insurance versus the ACA. And bringing the ACA and really this ICHRA platform and ICHRA as a whole into small employers is going to be huge for not only employers to have more stable cost amounts, as in how much they're paying for health insurance, but on top of that, employees are going to be able to actually choose the plan they need. Mm-hmm. And another thing on that note is I've recently gotten to the health insurance market on myself as of part of growing up and becoming an adult, I guess you could say, and needing to sign up for these things. And it was a harsh reality when I realized that health insurance for a basic plan at my company, at least, you're paying $75 a week. And that adds up quite a bit when you put that into a month and then a year. But then it's like, I don't even really use my health insurance that much. Why am I paying so much for a low deductible plan that I don't even use the benefits of as much? Mm. So this is why ICHRA is such a opportunity, in my opinion, because now I'm seeing this firsthand in my day-to-day life. Because when it comes to having that choice, if my employer were to say, okay, we'll change to an ICHRA, we'll give you $300 a month, I'm going to choose a high deductible health plan and then get an HSA. And then I'm going to deposit money into an HSA with tax-free dollars. And it just makes a lot more sense because I'm essentially paying for care that I don't need, just because you don't have that choice and that broader options when you have a marketplace situation like ICHRA, which is what Lucy would be offering, which is why Lucy is such a big deal and why a lot of people are excited on it. Mm-hmm. And especially if you scroll on LinkedIn, you have all of the brokers and Oscar affiliates all talking about Lucy, especially after it came out. So it's a very big deal. And essentially it's meant to streamline the process so you can have your funded dollars and choose all of your insurance needs related to your health all in one platform, where it is a streamlined process for everyone across the board.
Mm-hmm. So essentially the ICHRA provides more flexibility to the person who is trying to get insurance through their employer, correct?
Exactly. So essentially you can choose whatever plan you need, whatever fits your boat, instead of a lot of companies, at least in the US, I'm not sure how it is in Canada, but you basically have typically one or two options, really. You have typically a high deductible plan or you have a low deductible plan. And sometimes at some companies, they only have one plan, which is in the middle. So when you're going from one or two plans to basically anything that's available in your state, that is a huge shift. Mm-hmm.
Yeah, absolutely. So, sticking with Lucy here for just a quick follow-up, is Lucy more of a money maker for the company, or is it more of a funnel to sell more Oscar plans?
It's actually both, and I like that you mentioned that because I didn't add that to it. But essentially, they would be acting as like a digital broker in a way, I guess you could say, because they would be making a most likely a per member per month fee on each person that enrolls in it.
Mm,
But also, I would imagine they would also add like some sort of origination fee or an implementation fee, especially when you're talking software, and a lot of companies they charge fees of such sort where we basically onboard you to the platform, get you all set up. You'll pay an additional onboarding fee, which would be higher margin for Oscar than an
yeah.
ACA plan. Plus, you'd be making an every month per member per month fee on top of that, whether just to manage the funds through the platform, and that is a huge game changer for Oscar specifically, just because when you're talking a ACA insurance plan, which tends to be the gold standard of 5% margins, when you're taking a 5% margin and you're expanding that with, let's say, a software, which may have a gross margin of 70% or 60%, that makes endless amounts of differences, and especially with the opportunity, because one thing important to add to Lucy is that Lucy, to my understanding, is available in all 50 states going into 2027. Meaning right now, Oscar is currently in 20 states and 573 counties. And if they're going from 20 states to 573 counties, they have now over doubled their statewide exposure and over, I believe, quadrupled their county exposure as well.
Mm-hmm.
So it is a game changer for 2027.
Yeah, absolutely. And that'll definitely funnel into member growth as well. So when I was doing my research into Lucy, the biggest kind of reference that I made was Lucy is similar to like an Expedia sort of way for insurance. Would you say that's accurate?
Exactly. And actually, I believe there was an article that was posted that specifically had that major headline, the next Expedia of health insurance, or something to that effect, which I thought was very cool, or the Amazon of health insurance coming up. So I thought that was very cool. And they have Lucy, when they actually came out with the initial press release, they were like, health insurance needs to be as easy to enroll as booking a hotel. So it's very interesting.
Yeah, that is very interesting. And I actually didn't see that article, so that's pretty funny that you said that. Now, Lucy came live in the middle of April of this year. I want to back up to January 1st of 2026. I want to talk about the subsidy situation. So give us the whole rundown there. What happened and how did Oscar, continue to push through that?
Of course, yeah. So this can be a very long topic, and I'll try to keep it as detailed as possible, but also as short as possible.
Sounds good.
And essentially, in the ACA marketplace, there are subsidies, which essentially how these subsidies work is they are, in a way, a tax credit. And these tax credits limit the amount that you can spend on health insurance to certain degrees, and they're based on percentages. These go from, I believe it was 0 to 8.5% during the enhanced subsidies, and now they are currently 0 to 9.55% of the income on a monthly basis. So essentially, what that is saying is if you're in a specific federal poverty level, let's say you are less than 150% of the federal poverty level, I believe that's the correct bracket, you pay next to zero on a monthly basis for your health insurance because it caps it so aggressively. And these subsidies, what they end up doing and why they were so important for the open enrollment period and going into 2026 and why many carriers were worried about them is that it really helps have a more predictable level of churn, because if members are only paying, let's say, $0 through COVID on health insurance, if they're going from $0 to $150, for example, you might not keep all your members if $150 is a lot of money for them. Yeah. And also there was a lot of fraud happening where I believe Oscar is on the just about as far away from it as possible personally. But when you have a lot of these other carriers, when you have a $0 premium plan, if they're able to collect premium on that just by having some basic info, what makes you kind of think that they didn't have fraudulent signups? And that's what actually ended up happening. And that was kind of one of the tricky points on why they didn't get extended, was the fraud that was happening with them. And essentially, when these enhanced subsidies went away, what that caused is a lot of worry upon carriers and politicians and everybody across the board that the ACA was going to drop 20 to 30%, which was a very major drop in members. And that's not what happened at all for Oscar. And you saw other carriers, I believe UNH was one of them. I believe they had a 60% drop in members for the ACA. Cigna was another one. I believe Centene was another one. But many of these ACA carriers were losing a pretty drastic amount of their members compared to other ones. And a lot of it was all due to strategic pricing and being in the right place at the right time in order for Oscar to actually succeed in a marketplace where health insurance was rising drastically. So when you have this, what Oscar did in this situation is they set up a plan in their 2024 Investor Day, 3 years in advance, basically, years in advance. And they said, this is going to be a huge deal if these enhanced subsidies don't get reenacted and renewed. And just before I go on to this, the reason why the subsidies ended up going through and passing is because there was a multitude of reasons. And I obviously don't want to get political, but on both sides, they were very far off from a solution, and they were too far away from a middle ground, which ended up causing them to not go through. And by the time that either side wanted to kind of negotiate and get a plan going, the open enrollment period was already almost over. And so what they essentially said is, we're going to make this, some politicians said, is we're going to make this a midterm issue and work on it for midterms for the 2027 open enrollment period. But back on Oscar's really strategic plan, what they essentially said is, we're going to supply all of our brokers. And I actually just was going through an interview to kind of refresh myself on this a few minutes ago, was that Oscar actually sent technology out to them, to their brokers, to 17,000 brokers, and said, here are our members. Here are your members you're handling. These members, we think it's possible they might churn off. And because they might churn off, I'm going to give you all of the product offerings that are likely the best fit for them to stay enrolled, keep their insurance, and minimize their actual out-of-pocket costs. And this is why Oscar was so successful, because while other companies hesitated, they were like, oh, well, they might be reenacted, they might not be reenacted. What they said is, we're going to assume the absolute worst. And in a time where the worst happens, we are going to be way more prepared than everybody across the board. And that's exactly why they ended up succeeding, because they built in a complete spectrum of product offerings that were a great fit for individuals in order to get them the cost they need that was affordable, and a way for them to actually manage their healthcare costs, which is what we ended up seeing in Oscar's their metal mix. Their metal mix was a huge shift. I believe 70% used to be silver. And in the ACA, you have bronze, silver, gold, and you have platinum. And then there's some other ones as well. But essentially, they went from around 70% in their silver category to about, I believe, pretty much almost an equal split across all categories. They had a major boost in bronze, and bronze is a very high deductible. You can have a few $1,000s for a deductible. Silver is, of course, in the middle, and gold is going to be a low deductible, maybe around $800 or $1,000 deductible. So when you have that, it kind of leveled their playing field from a plan in just financial economics, because they have a huge increase in plans that are extremely profitable because they have a very high deductible. But then you also have a big increase in less profitable and more rich in benefit plans through gold. So it kind of ended up resulting in a big strategic shift in how Oscar was actually managing their members, because they put their member first and said, okay, well, you're not receiving these very rich government benefits. We're going to get you the exact plan you need, so you stay with us to really increase that lifetime value. So their execution through the open enrollment is actually, it was the best out of the entire industry. And we kind of saw that, because while the market saw 10+% drops, Oscar saw a 60+% increase in members.
Yeah. Yeah, that's pretty incredible, to be honest. If all of their competitors are losing a lot of their members, but Oscar gains, I believe the number was 65%. But that tells a lot about management and their long-term vision for the company, right? You said this was back in 2024 when they had this vision and talking about how they're going to prepare themselves if the day were to come, and even before January 1st, like they were already preparing for the worst. So I think that definitely helps and talks about Mark and his long-term vision for the company, which is obviously great to hear, great to see. Now, if hypothetically speaking, if Congress were to bring back the discounts, what does that do to the stock, and is that even a possibility?
Yes, so I think that is a very well a decent possibility that could end up happening, but I don't think it's going to be anywhere near as straightforward as how it used to be. I think if anything were to happen this year, it would be towards that time period around midterms. Mm-hmm. And there is actually a great healthcare plan, is what it's called, that Trump and the White House is currently pushing. Now, what this would do is this would enact CSR payments to insurers again, which essentially would remove the need for silver loading currently, which would reduce the costs of silver plans quite drastically, over 10% in many cases, because of a weird economic way of how silver plans are actually priced. And on top of it, what that would also do is there's also talks of adding an HSA program, kind of similar in a way to ICRA, that with many of the proposals that I have seen, they kind of include those HSA plans to allow individuals to use the money given by the government to pay their insurance premiums. So a typical HSA account, you can only use kind of for medical costs and those sort of costs. Mm-hmm. And this would allow you to do that, but also pay for your insurance premiums. So going back to the kind of CSRs and the silver loading, essentially what a CSR is a cost sharing reduction. Now, to a degree, it is difficult to kind of explain the all complete in-depth of what they are. But essentially what they do is if you're at a lower percentage of the federal poverty level, you can qualify for CSRs. And I believe it's 0 to 150%. And what that does is it limits your copays and deductibles. And the insurance company doesn't receive any money currently because it was redacted or it went away in 2017. So now what Trump is now reoffering to do is have these payments go to the insurers again, which would bring down the cost of silver. And what that essentially did was if you have a bronze plan for $400, you have a silver plan for $600, your gold plan might be $550. And the economics behind that is extremely backwards because why would the silver plan, the middle plan, cost more than the gold plan? Yeah. And that's because these cost sharing reductions only apply to silver plans. So if you're 0 to 150%, I believe, of the federal poverty level, and you're in that silver category, you're able to qualify for CSRs. And since they're able to qualify for that, and the government subsidies are going to cover the excess over the monthly premium anyways, as the percentage, these insurance companies have to charge more to pick up the cost of lowering such an incredibly low copay, deductible, etc. across the board for these individuals. And if they reenact the CSR payments to insurers, and now this is all my understanding of it, the economics behind it would essentially fix the pricing on a monthly basis, going from bronze to $400 maybe, to silver to $450, to gold to $500 maybe. And it would really have a more realistic selection of plans, because if you're not subsidized, then you basically only have the option of bronze or gold, because why would you pay more for a silver than some gold plans and get less benefits, especially when you're paying completely out of pocket? So if this all goes through, which I personally believe there's going to be a middle ground compromise, especially since you have more so a Republican anti-health insurance company government currently at the moment. But when you kind of stabilize that with, of course, Democrats tending to be more pro health insurance and giving people benefits and really subsidizing a lot of those costs, you kind of end up getting a middle ground where it ends up being some sort of maybe a subsidy extension plus maybe adding back those CSRs. And ultimately, that would be very positive for the stock at the end of the day when it comes to a middle ground perspective, because the whole point of it is to reduce churn essentially and get more people on the ACA and, grow the actual individual market.
Yeah, that was a fantastic, detailed answer there. So I want to turn to profitability. And you mentioned it briefly earlier, but Q1 for Oscar was very solid. Typically, Q1 is the best looking quarter for health insurers. So I want just to get your opinion on the quarter, but also where do you see profitability for the company going in the future?
Of course, yes. So when it comes to actual profitability in Q1, they reported absolute incredible results across the board. Nobody, even myself with the most bullish estimates, thought what happened in Q1 was going to happen in Q1. And so I kind of wanted to shed some light a little bit on that, And this is where my accounting background kind of helps me out quite a bit, is that when you dive into their earnings and what they're actually expecting for the year, first off, they reported a 70.5% medical loss ratio, the lowest in the industry. And they reported a 15.2 SG&A ratio, which was on both notes a drastic decrease year over year. But the most important thing about the entire earnings call, which I literally mentally fell back off my bed when I read it off my phone, I was like rolling off my bed as I was reading it, and I just like basically fell off it, is they reported a 24% risk adjustment in Q1 as an accrual because their new member utilization was so low. And essentially what that did is that basically sandbagged all of their metrics across the board, because the way that risk adjustment accrual works is that first I want to say what risk adjustment is first, actually, before I go into deeper. Yeah. If you don't know and you're watching this, risk adjustment is essentially a net zero in the ACA market to prevent discrimination. So if you have it's all based on risk scores. If you have a sicker population, you'll have a higher risk score because you have more higher risk members that are going to need more medical costs. When you have a lower risk member, you're going to have a lower risk score. And so essentially what ends up happening with that is there are receivables and payables. So if you have a sicker population or a higher risk score member base, you're going to have a receivable. And if you are in the other end where your population is super healthy, which is what Oscar is, with a 38-year-old average member base, what that ends up causing it to be is that they have to pay into the market because they have super low risk, low utilization members comparatively. And so what they did in Q1 is that they basically said on the earnings call, which is what made me fall out of my bed basically, is that they had expected still a 20% full year risk adjustment. And why that is so important is that in 2025, the actuals were around 18.5%, but in Q1 of 2026, they accrued at 24%, meaning when you're accruing higher than what your full year expectations are, they have to have a reasonable reason to actually do so in order to have accurate financial statements. And so the reason why they did that is because since they had so many new members and they weren't used to their care yet, their medical costs for Q1 were super, super low at 70.5%. Numbers actually lower if you normalize it. And when it happens to have the risk adjustment at 20% full year, and if you adjust Q1 2026's risk adjustment, which by the way, risk adjustment affects both their, all three of one, their medical loss ratio, two, their SG&A ratio, and most importantly, their top line of what they're reporting, because they're reporting net revenue. So it's gross premiums minus risk adjustment equals their net premium that they're actually receiving, because that because it's basically treated as similar to like a sales discount. You're never seeing that money because it was given right at the start.
Yeah.
And what that actually does is if you normalize it, and this is where I thought was absolutely incredible, because in order to normalize their medical costs, because they had so many new members, they ended up sandbagging their top line and all of their ratios to try and normalize their MLR to kind of showcase that. Because when you have a 24% risk adjustment accrual, that turns 4.8 billion, I believe it was, into 4.6 billion. Mm. And then what that also does is it turns 70.5 as an MLR to 66.9. And it takes 15.2% as an SG&A ratio and brings that down to about 14.43%. So essentially, when we're talking full year 2026, it is going to be a year of 8Ks and guidance being reaffirmed, which we've seen. I believe guidance has been reaffirmed about 6 times this year so far, which for a health insurance company to do that, I don't think I've ever seen that before.
Yeah.
I think that's very crazy.
Yeah.
And also in Q1, I did want to note, and I actually have this up here as the quote, is that they actually had a prior period development, a PPD, which was favorable for $68 million, which they actually chose to not actually recognize. And what that ends up doing is because 2025 was such a harsh year that they didn't want to risk having a repeat situation where they had a rough weekly report and it ended up being recognizing a lot of positive and then get hit with a huge negative hit. And so what actually happened, and they actually had a presentation at Goldman Sachs yesterday, which was insane. It was one of the best conferences that I've ever heard from Oscar, and the amount of confidence from Scott speaking was insane, is that they actually had a $130 million favorable prior period development that is set in stone with the final 2025 weekly report, meaning their full year guide, and I have it up here, I believe it was 250 to 450 million for their earnings for operations. 30% of that midpoint is being recognized in Q2. So 40% of their full year guide, they just hit with a positive prior period development from 2025, which is going to hit their 2026. So let's say they hit the high end, which a lot is assuming that that is going to happen, 450 plus 130, we're already at 580. And not to mention if beforehand we were already going to beat that, we're getting into the discussion of maybe management has been sandbagging this entire time, and that quote and video from Mark of hitting 5% margins is actually going to be hit this year. And it truly is one of those insane under promise and over deliver situations.
I was literally just going to say, so you're expecting, based on the numbers that you've ran, you're expecting that management is sandbagging from this year, and you think they're going to come in and just absolutely beat these numbers like crazy.
Once that weekly report comes out, I honestly believe there's going to be another 8K that comes out. And if they confirm risk adjustment at 20% for the full year, everything is going to be smashed out of the park, in my opinion.
Do you know when that's supposed to be released? Is there a date?
End of this month.
End of this month. Okay.
So end of this month. And also to note is that right now, management is acting upon all prior known headwinds that happened in 2025. So when they went through Medicaid redeterminations in 2025, also upon the industry-wide increased utilization across the board, that ended up kind of scrambling up, the entire risk pool for risk adjustment, plus they had cost utilization pressures. So they took a major hit in 2025. So what they did is a 28% weighted per member per month price increase year over year, which was high, but also lower than other competitors that were doing 35% and 30% or so price increases. So when you're combining a drastic price increase plus prior period developments plus lowest industry-wide MLR in Q1, it's setting up for a very strong 2026.
Mm-hmm. Absolutely, and it sounds like it. And speaking of, future growth, this is my last question before we end the interview, because I know we've been going for about 35, 40 minutes now. So the last question that I want to ask you is about valuation. I want you to tell us what you think, Oscar is worth today, and what are your long-term targets for the stock price?
Of course, yeah. So first, I want to say that throughout this entire process of posting about Oscar, just across the board, it's very difficult for people to take you even remotely serious when you're 21, and obviously when you're 21 you look younger, and on top of that, saying that every health insurance company is going to suck and not do as great, and also Oscar is different from everybody across the board and they're going to do well. It's not exactly easy, and sometimes people don't really take you serious when you say that. So it's great to see everything working out so far. And personally, in terms of valuation, what I've kind of mentioned everywhere is minimum, I see $35 this year. And, that seemed so crazy a month and a half ago when we were at $10.85.
Yeah.
But now we're, $7-8 away?
Yeah.
So everything's changed. And what I basically told everyone, for just the sake of credibility, because I don't want to put outlandish price targets out there and kind of never hit those, and people be like, oh, you said this goes to this. So I basically said 35 minimum, and then I can see 45 to 55, depending on how things go. And currently at the moment, from an EPS standpoint, I think that 250 isn't impossible. And when we're talking 250 at a 20 times PE, which, by the way, 20 times PE, I don't even think is realistic for the fact that they're growing 60%.
Yeah.
As long as they get a credible valuation, there's a very strong chance that it's going to be 45 bare minimum, and more so along the lines of 50 to 60.
And that's end of year 2026 target?
Yep.
Okay.
And it's crazy to say that after being at 1085 and now we're here. So
no, I like it. I mean, clearly you know a lot about the business. You've done your research, and you have built such conviction in a company to ride it from 12 to 22 back to 10. Now we're at 27. Like, it's been an absolute roller coaster, and you've been there, through the ups and through the downs. And I think that's something that I want everybody to take away from this video. Not only, Oscar specific, but just when you're doing your research, and if you're owning and buying individual companies, you have to be doing the research, the due diligence to understand what it is you're buying. So when the stock drops 50%, which stocks drop 50% over a couple months, like all the time, right? I've been in a few myself. And if you don't do your research and you don't have conviction that the business is growing and they're still going to be in a good spot regardless of how the stock price is performing, then you're going to most likely sell at a loss. And it's going to be the worst time to sell because you're going to be buying high and you're going to be selling low. So, I want people to take away from this interview. Obviously, Anthony's dropped some gems, and he's provided a lot of value for not only myself, but for all of the viewers. But, I want you to take away that he can come on here and talk about the company and answer all of these questions. Like, you should be able to do the same or similar for the companies that you own, and be able to do that research and actually build conviction in the stock for the long term. So this has been such an incredible conversation, Anthony. I really appreciate you coming on and, providing a ton of value for, not only myself, but also the viewers as well. Do you have any last words before we wrap this up?
I have two things. First, it's First, it's incredibly easy to stomach a hold on a company that you truly understand versus holding a company off of borrowed conviction. When you're in the thick of it and it's, incredibly horrible waves in the water and all the ships are crashing, your ship is going to be up there and it's going to be, you're going to find all the gold all around you if you're able to stick it through and understand what you're in, your thesis. And, if you're wrong, you miss something. But at the same time, it's better to do all of the research you possibly can and understand it in and out. Because if you know everything truly in and out, your probability of failure is only possible due to things that just are completely out of your control. And that's ultimately what investing comes down to a lot of the times, because when good traders and good investors end up failing, it's because stuff they truly can't control. For example, policy risk or something of that nature across the board with any stock or any position. But I do want to kind of say, maybe I'm on the other side of this. Maybe I'm on the other side of this podcast with someone else in the near future, but we'll see. Dropping hints a little bit. But anyways, it's been a great podcast.
Awesome. Yeah, we got some, hopefully some really cool things to look forward to in the back half of the year with Anthony and Oscar. Anthony, thank you so much for coming on. We will have all of Anthony's links in the description of this YouTube video, along with Summit Capital, which is my free investing community. Anthony is a member in there, and we're talking about a ton of stocks. He's in the Oscar chat, giving us value as well. So if you want to join that, feel free to click the link below. And then also Blossom. Blossom is a social media for investing app. Me and Anthony are both on Blossom. You can see our portfolios, see what we're buying, what we're selling. It's free. It's pretty cool. There's going to be a link below to join that as well. Guys, this has been the Oscar interview with the man, the myth, the legend, AC Invest. Anthony, really appreciate you, and I hope everybody has a great night.